Three childhood friends turned a single Greek restaurant into a $10 billion empire, only to face a nightmare that threatened to tear it all down. In 2024, Cava was the hottest stock on Wall Street, with investors calling it the next Chipotle and valuing every single location at nearly $30 million. By February 2026, the hype had collided with a brutal reality of $18 lunch bowls, scathing sanitation reports, and a stock chart that looked like a ski slope. While the billionaire backers cashed out early, thousands of ordinary believers were left holding the bag. Walk into a Cava in early 2026, and you might notice the lines are shorter. For years, the fast casual chain relied on a simple promise of fresh, healthy Mediterranean food, served fast. As inflation gripped the economy, that promise came with a steep price tag. A standard bowl with a scoop of crazy feta and a drink started pushing past $18 in major cities. For the average office worker, lunch became a luxury expense. This pricing strategy worked perfectly when the economy was roaring and consumer spending was high. But as wallets tightened, that $18 receipt became a symbol of corporate disconnect. The company insisted their premium ingredients justified the cost, yet customers began to choose cheaper alternatives or simply pack a lunch. This was the first crack in the armor of a company that Wall Street said could do no wrong. Long before the billion-dollar valuations, Cava was just a dream shared by three sons of Greek immigrants. Ted Xenochristos, Ike Grigoropoulos, and Dimitri Moshovitis grew up in Rockville, Maryland, bonded by their heritage and a love for food. They didn't start with a massive chain, but rather a single, full-service restaurant called Cava Mezze in 2006. It was a local hit known for its authenticity and Dimitri's recipes. The friends saw something bigger happening in the food world as they watched Chipotle change how Americans ate, proving that people wanted quality food without the waiter service. They decided to take their flavors, package them into a fast casual format, and launch Cava Grill. It was a risky pivot, trading the stability of a successful sit-down restaurant for the cutthroat world of fast food. But they believed their spicy lamb meatballs and harissa spreads could conquer the market. Great food does not always make a great business. The three founders knew how to cook and serve, but scaling a chain across the country required a different set of skills. Brett Schulman, a former investment banker who had left finance to sell snacks, met the founders and saw the potential immediately. He didn't just become their CEO, but actually became the fourth partner. Schulman brought the financial discipline the creative trio needed by standardizing operations, focusing on data, and preparing the company for aggressive growth. Under his leadership, Cava became a data-driven machine, tracking everything, from how long a customer stood in line to which toppings were running out fastest. This obsession with efficiency would eventually attract the attention of the biggest money in the food industry. We are uncovering the truth behind the biggest business stories of 2026. If you want to stay ahead of the curve, hit that subscribe button and turn on notifications. Now we will meet the billionaire who changed everything. To go from a regional chain to a national powerhouse, you need serious capital. Ron Shaich, the billionaire founder of Panera Bread, is a legend in the restaurant industry who practically invented the fast casual category. When he saw Cava, he saw the future. Through his investment vehicle Act 3 Holdings, Shaich poured nearly $300 million into the company. This was the turning point. With Sheich's backing, Cava wasn't just growing organically anymore, it was turbocharged. His involvement signaled to the entire market that this was the winning horse. Shaich didn't just write a check, but became the chairman of the board to guide strategy and open doors that were previously closed. As we would later see, having a billionaire in your corner is great on the way up, but it can complicate things on the way down. In 2018, Cava made a move that shocked the industry by acquiring Zoës Kitchen, a struggling rival that was actually much larger than they were. At the time, Cava had about 66 locations, while Zoës had over 260. It was a minnow swallowing a whale. The audacious plan was to buy the dying chain, take its prime real estate, and convert every single location into a Cava. It was a brilliant real estate play that allowed them to expand rapidly into the suburbs and the south without having to hunt for new leases. But conversions are messy, expensive, and time-consuming. For years, the company burned cash refurbishing these old stores, betting that the Cava brand would generate enough revenue to pay for the massive debt they took on. For a while, the bet seemed to pay off. On June 15, 2023, Cava went public, and Wall Street lost its mind. The stock opened at nearly double its offering price, instantly valuing the company at nearly $5 billion. Investors were desperate for a growth story, and Cava delivered a narrative of consistent growth, a cult-like following, and the comparison to Chipotle that every analyst loves to make. The three founders rang the opening bell as overnight centimillionaires. Brett Schulman was hailed as a genius. The stock kept climbing month after month, defying gravity even as interest rates rose. By 2024, the valuation had ballooned to over $10 billion. At its peak, the market was saying that a single Cava location was worth more than some entire companies. It was a classic bubble, fueled by hype and the fear of missing out. When you are valued at $10 billion, perfection is the minimum requirement. By late 2025, perfection was nowhere to be found, as the rapid expansion from the Zoës Kitchen acquisition began to show cracks. Training new staff for hundreds of locations simultaneously is a logistical nightmare. Customers started noticing that portion sizes seemed to shrink. The consistency of the flavors, which Dmitry Moshevitis had built his reputation on, began to waver from store to store. Online forums filled with complaints about cold food, messy serving lines, and that ever-increasing price tag. The company was growing so fast, it was tripping over its own feet. They were opening new stores to keep the stock price up, but the operational discipline that Brett Schulman was famous for started to slip under the pressure. Hunterbrook Media then released a bombshell investigation that shattered Cava's pristine image. They looked at health inspection reports rather than just balance sheets, and the findings were stomach-churning. The report detailed critical sanitation violations across multiple locations, including issues with filth flies and food stored at unsafe temperatures. Several locations in New York had received C grades from the health department. For a brand built on the concept of health and freshness, this was a catastrophe. The report went viral as TikTok exploded with videos of customers analyzing their bowls with suspicion. The stock took an immediate hit, dropping 12% in a single day. Management tried to dismiss the issues as isolated incidents, but the data suggested a systemic failure to maintain standards during their rapid expansion. Retail investors were buying the dip, thinking the hygiene scandal would blow over, but the insiders were selling. Filings revealed that Ron Shaich and other early investors had offloaded hundreds of millions of dollars worth of stock in the months leading up to the crash. They didn't sell at the bottom, but near the top. This part of the story stings the most for the average investor. The people who knew the company best, seeing the operational strain and the slowing traffic numbers before anyone else, secured their fortunes while the public was still buying the hype. It wasn't illegal, but it sent a clear message that the smart money knew the party was over. The billionaire backer had made his return, leaving the market to deal with the fallout. By February 2026, the dam broke when Cava released an earnings report that missed expectations on almost every metric. Traffic was down, and same-store sales had turned negative. The $18 bowl was simply too expensive for a consumer base dealing with economic uncertainty. The stock, which had traded as high as $130, crumbled. In a matter of weeks, it shed nearly 50% of its value and wiped out billions in market capitalization. The $10 billion dream turned into a $7 billion reality check. Analysts who had slapped buy ratings on the stock just months earlier were suddenly downgrading it, citing valuation concerns that had been obvious for a year. The narrative of the next Chipotle was dead, leaving Cava as just another restaurant chain fighting for survival in a crowded market. Cava's stumble sent shockwaves through the entire fast casual industry. It wasn't just about one company, but served as a warning sign for everyone. Investors started looking at other darlings like Sweet Green and wondering if they were next. The Cava shock proved that you cannot scale indefinitely without consequences. It also highlighted a growing divide in the restaurant world. On one side, you had the giants like McDonald's and Chipotle, who had the infrastructure to weather the storm. On the other, you had the high-growth challengers, who were suddenly looking very fragile. Even the billionaire owners of Panda Express, the Churn family, who have quietly invested in various food concepts over the years, likely watched this collapse as a validation of their own strategy of slow, private, controlled growth over public market hype. Cava is not finished by a long shot. They still have hundreds of profitable locations, a loyal fan base, and a product that is delicious when done right. But the era of easy money is over. Brett Schulman and the founders now face the hardest challenge of their careers as they try to win back trust. They have to fix the sanitation issues, stabilize the prices, and prove to Wall Street that they are a real business rather than just a growth stock. The company has announced plans to slow down new openings and focus on store operations. It is the boring, unglamorous work, but it is the only way to survive. The stock might never see those 2024 highs again, but if they can stop the bleeding, they might just survive the nightmare. The rise and fall of Cava teaches the difference between a great product and a great stock. For a while, the market forgot that at the end of the day, this is a business about selling hummus and pita. When the valuation gets too far ahead of the reality, a correction is inevitable and usually painful. The $18 bowl was a symbol of an era that has passed. If you want to understand more about how market bubbles form and burst, make sure you're subscribed to the channel. We will see you in the next one.